Um, 206 meeting of the Audit Committee, Metropolitan St. Louis School District, Tuesday, May 31st, 2022, 2350 Market Street. Roll call by the chair.
All right, we'll note that all trustees except trustee Fair are present.
Approval of the committee meeting minutes, May 22.
So moved. Second.
Comments by the chair. Morning, Todd, internal audit.
Good morning. Good morning, everyone. So we, what's that? Good morning, everyone. First of all, I want to introduce Ron Steinkamp over here on the other side of the table. He and I run the internal audit function together. He's from Armanino. You guys probably haven't met him with all the COVID stuff going on in the last couple of years. So I thought it was a good idea to have him here to go over the audit plan for this coming year. So he's a big part of what we do. He and his team, we form the internal audit function together. So this is our recommended plan. I sent you a list of the engagements that are going to be in the plan. So that has not changed. The original list I sent to you is what's in the plan. So if you have any thoughts or suggestions during our presentation, please let us know. I'm not necessarily going to go over every slide in this presentation. I don't think it's necessary for our purposes here. So we're all using this presentation right here. So with that, let's move on to slide 3. That's slide 3. And it should say sources and types of audits at the top of the slide. So before I go over the internal audit plan, I just want to spend a couple minutes clarifying the 3 different audit teams you'll be hearing from over the next 6 months. First, you have the external financial auditors. They're focused on the financial statements. That's Clifton Larson Allen. You met them a couple months ago. They made a presentation on their planning communications. Then you have the management audit. The management audit team, they're doing an entity-level control management audit. That's UHY Advisors. That is the audit that is required. That's the management audit that is required every 5 years by charter. So you won't see that every year. But you're going to see it this year. They're in the process of finishing that audit up. You'll see a report and a presentation from them, probably in one of the next 2 meetings. So sometime over the summer, you're going to see a presentation from UHY. And then obviously you have the district internal audit team, which is myself, Ron, and the team from Armanino. So move on to slide 4, explain the differences of what we do a little bit. Now, the external financial auditors, again, their main focus is the financial statements, the process controls around the financials, the accuracy of the financials, the fairness of it, make sure they're fairly stated. Their number one goal is to focus on the financials. Now, when we do our audit work, we kind of stay out of that area. Once in a while we go up in the area, but we know they're looking at it very thoroughly, so we don't look at the financials that much. Looking at the processes across the district in different areas, we kind of get in the weeds in areas they don't have time to get into, so that we'll get good coverage that way. Now, the next slide 5. Now, this kind of compares to what the difference between the management audit and what we do. You can see the control structure there. The management audit focuses on entity level controls across the district. It has more of a top-down focus. They're looking at the controls at the top and kind of working their way down. Now, when we do our work, we're kind of getting down in the weeds. We're looking at the activity level controls, and we're kind of operating more from a bottom-up approach. So it kind of it's good that we get a couple of different perspectives and different views of our control structure. I think we get good coverage that way. So any questions? With that, let's move on to slide 7 and start discussing the internal audit plan. As far as our risk assessment methodology, this slide moves left to right. You can see the items on the left-hand side. Those are items that we consider during our risk assessment. We review any current events, circumstances affecting the district. Do we have additional capital capital programs? Is there a new IT initiative? Is there a new consent decree? Whatever it may be, we take that into account when we're doing our risk assessment. Review the prior engagements, the results, the coverage. We hold discussions with the executive team and meet with the directors. Ron and I and his team would get together. We have a kind of a think tank. We got ideas back and forth, discuss risks. Look at the strategic plan, look at the financial statements, basically take all that information together, evaluate it, identify key areas, evaluate the risks, line them up, develop a plan. And so if you go on to slide 8, this will explain the mechanics of it a little better. So basically, we had a big spreadsheet. It lists each area, each area under each department. And we assign points based on attributes or factors. So we assess the overall importance and risk of each area. Is it a key area? What are the risks? We assign points based on that. For the date of the last audit, was it 10 years ago? Was it 2 years ago? The results of the last audit, was it really clean? Do we have a lot of issues? Again, we assign points. Any recent developments, other factors. Was there turnover in the department? Is something new? Again, we come up with a point total for each area, and that's basically kind of mechanically gives us a list of our audits we're going to do. Any questions? Slide 9. I just want to show you this really quickly. This is just we use this as a visual check. This lists out all the audits by department that we've done over the last 10 years. I use this to go over the audits with the directors. It just gives you a good visual. Helps us see, as a second check. Again, I just wanted to kind of show this to you. With that, let's move on to slide 12. Now, to kind of remind you guys, the overall internal audit cycle operates, basically right now I'm doing the audit plan. So we audit throughout the year. And then based on those audits, we issue recommendations. The process owners develop action plans, and then they implement changes based on those action plans. And then we'll come back annually and we do follow-up. To make sure, actually they're following through with their action plans. We will give you a status update in either October or November, let you know which items are still open, what their status is, what kind of progress has been made on these recommendations. So with that, let's move on to slide 14, and we'll start talking about the engagements in the plan. So that is slide 14. So these are in no particular order. So the first engagement concerns the collection cycle. The last time I looked at this area was back in 2018. For your information, the district currently utilizes 5 collection agencies and 3 law firms to facilitate the collections effort. Obviously, this is a very important area because district, very much so wants to maximize collections from our billings. We have to support operations. Another big item as part of this is making sure the customers are treated properly by our collecting agencies. We don't want anybody crossing the line. We want to make sure they're not harassing the customers. They're following the Fair Debt Collections Practice Act. So we actually do go out to each one of these facilities or each one of these third-party service providers, and we audit out there for a couple of days on site. So it's a pretty long audit, but I think it's worth it. Any questions on that one? Let's move on to slide 15. Plant pump station systems, cybersecurity and business continuity disaster recovery. That's a mouthful. The last time I looked at this area was back in 2019. So these are the systems that are used to control and monitor the operations for the plants and the pump stations. There's 2 different systems. There's a SCADA. You've probably heard of that one. It stands for Supervisor Controlling Data Acquisition. That's generally a system that's used for applications that are spread out over geographical area, like our pump stations, because they're spread out all over all over our district. And then the plants use a system called DCFs, Distributed Control Systems. That system's usually used to handle operations at a single footprint or single location. Now, these systems are in a separate network from our business network. So these are handled mainly by operations personnel. I do get some assistance from IT, but mainly this is an operations system. You know, they're managed by operations. So we want to make sure, you know, the data system security is adequate, the physical security is adequate. We want to make sure they have a solid business continuity disaster recovery plan in place. They're just like the business network. That is still maturing. They're trying to mirror what IT is doing with the business network, so they're still working on that. So we'll look at that when we do this audit in the spring, which kind of leads me into the next audit at slide 16, the business continuity disaster recovery. So this audit we just completed a couple months ago. That was the first true audit of this area. If you remember, it went really well, but this whole area is still maturing. With that in mind, IT is going to do another exercise in the fall. And when they do that exercise, we're going to audit and review and see how it goes. And we'll do another report and report back to you. So hopefully it'll keep maturing and keep improving like it has. Any questions there? Next item is a review of overhead rates. This is not really an audit. It's something that we do every year. We review the overhead rates that's used in billing for what they call cost plus contracts. Usually it involves our construction management contracts or design consulting contracts. There's an overhead rate they use in the billing to bill us, and we review those rates, make sure they're calculated properly. They're not included in expenses they should not include in the cost pool. Just make sure we're getting billed properly. So we do that for every contract. They come up with a new rate every year based on previous year's financials. So we review those every year. Any questions? All right. Next item, slide 17. Network vulnerability, attack and penetration. So this is an audit in which we use our ethical hackers to try to compromise the system. We literally just finished one of these about a month and a half ago. We had that report ready for you either next audit meeting or the following meeting. So we've done one the last 3 years, and each year we're seeing improvement, which is really a great thing because it's a very important area. As you guys all know, cybersecurity is an ever evolving area right now. Threats are ever evolving. So it's very important for the district to stay current in this area. So our best practice is really to perform this every year. So we're going to continue to do that, kind of an all hands on deck approach to this area. So we want to be as proactive as possible around this area. IT is doing a lot of work, so we're just doing our part, try to help out as much as we can. So the next engagement is the fraud risk assessment. Now Ron over here, he is a CFE, he's a certified fraud examiner, and he'll be taking the lead when he does that, when we do that work. So I'm gonna let him talk about that one and a couple other things.
Thanks, good morning, everyone. Yes, Dad mentioned the fraud risk. What we focus on there, for an employee of the district who commits asset corruption, back, there's a third phase of this. Sorry about that. Third phase, which is financial statement fraud. We don't go into as much detail on that. As Todd mentioned, you do have an external financial audit that occurs every year, so we're not going to focus on that so much. But this is an important area. We do it every couple of years. It's a best practice, I think, for the district to do it every couple of years. Last time was 2019. So you're right on schedule to do another one. We do get some very good findings out of these, some things that the district can really improve upon after we've conducted the fraud risk assessment. So any questions on the fraud risk assessment? Great. All right, so if we go on to slide 20 then, the next Audit is a construction contractor, audit of contracts in progress. We have a dedicated construction audit team at Armanino. That's all they do is they audit construction contracts for owners. So we'll be taking a look at those contracts that are out there for the district. As you know, this is an area where the district spends quite a bit of its dollars, from a capital perspective, with Project Clear, the consent decree, very high profile program. So we're going to focus attention there, make sure that your significant risk in the construction contract area are covered. Any questions on that one? Great. We'll go to slide 20 then. Really the completion of this year or the fiscal year 2022 audit plan. Just to kind of give you a schedule where things are at. I think Todd had mentioned earlier the attack and penetration / phishing will probably present at the July or August audit committee meeting. There's a safety audit that will be presented at either the July or August meeting. We took a look at the healthcare administration of the healthcare plan. We'll present that in September. And then DEC looking at industrial pretreatment will be presented in October. All engagements for the current year, they're either be completed or in process. They are either completed or in process. And the current year plan usually falls over into the summer months, so a little bit of overlap with the fiscal years, but we'll get it all completed by the end of the summer. Any questions? Todd, I'll kick it back to you.
No, I don't have anything. No, if you guys, anybody have any questions? We appreciate it. Thank you very much.
Thank you, Todd. Thank you, Ryan. Next meeting, tentative date, July 5, 2022. Meeting adjournment.
So moved. Second.
Adjourn.
Trustee Nicholas, and we'll get things switched out. We'll get ready to go as soon as we
Good evening, everyone. Welcome to the 230th meeting of the Program Management Committee for the Metropolitan St. Louis Sewer District, Tuesday, May 31st, 2022. Can I get a roll call?
We'll note that all trustees, except trustee Fair, are present.
Approval of committee minutes of May 3rd, 2022 meeting.
So moved. Second.
No comments by the chair. Engineering Department agenda item. Rick?
Good morning, trustees. A few items this morning. The first three items we have are CSO volume green infrastructure grants. The first one is for St. Louis University Jesuit residents. This ordinance authorizes the district to enter into agreement with St. Louis University, provide financial assistance through the green infrastructure grant for the program for construction of green infrastructure. The purpose of this project is to reduce combined sewer overflows to the Mississippi River per the long-term control plan and the consent decree. This project will reduce runoff volume with the installation of one bioretention basin. The total cost of this project is approximately $105,924, and St. Louis University is requesting approximately $104,400 reimbursement for the cost of green infrastructure. In your packet, there's a location map of where this is located. It is in Vanderbilt, Forest Park area. It's actually on Laclede Avenue. There's a residence hall, a residence building there, and they're putting in a bioretention to capture the runoff from the roof of the building at that location. Next item is a green infrastructure grant being awarded to Vista Avenue lots. This is authorized the district to enter agreement with UIC Homes LLC, provide financial assistance through the grant program. The purpose of the project, again, is to remove combined sewer overflows from the Mississippi River for the long-term control plan. This project will reduce runoff volume with the installation of 5 rain gardens. The total cost of the project is estimated at $33,745, and UIC is requesting $33,745 reimbursement for this project. These lots located for Vista Avenue are located in the Lafayette Square area. There's some redevelopment of lots taking place along Vista Avenue, and they're installing 5 rain gardens to capture the runoff from the roofs of that redevelopment of those lots at those properties. Questions on that one? Then the third grant today is for Grand Avenue Mixed-Use Development Project. Again, authorize the district to enter agreement with Steel Coat Gratiot LLC for financial assistance through the grant program. This grant will reduce combined sewer overflows to the Mississippi River. This project will reduce runoff with the installation of pervious pavement at this location. The total cost is estimated at approximately $149,591, and the developer Steel Coat Gratiot is requesting approximately $147,600 reimbursement for this project. Location map there. This project is again kind of in the St. Louis University area, just south of Highway 40 along Father Biondi Expressway and near the Shoto Avenue, corner of Shono and Father Biondi Expressway. As you can see, there's a large parking lot for this facility, and they're putting in pervious pavement, which will allow the combined sewer the stormwater to be captured and put into the ground, which reduces the combined sewer overflow. Okay.
Is Father Biondi, is it Grand Avenue?
Yeah, that's Grand.
Okay.
They renamed that section there just south of Highway 40 for the new hospital right there.
Gotcha.
All right. Next item is Stanwood Drive and Bellwood Drive storm sewer and bank stabilization project. This appropriates additional funds to an ongoing construction contract with Above and Below. This was an unplanned supplemental appropriation. In other words, it was not in the budget. The work on the contract consists of construction of approximately 250 feet of natural channel stabilization, approximately 220 feet of storm sewers varying in size from 12 to 30 inch in diameter and appurtenances. The purpose of the project is to alleviate bank erosion near the 5300 block of Stanwood and to alleviate basement flooding at the address 7528 Stanwood, and street flooding along Stanwood and Bellwood in the city of Normandy. This supplemental appropriation is for $75,000. The original appropriation was for $340,000, which will make the total appropriation for $415,000. These additional costs is during the creek bank excavation or during the creek bank restoration, there was additional rock excavation required by the contractor. It wasn't anticipated. We did have boring holes in the area, but where we hit rock, of course, is where we did not have boring holes. And with that additional rock excavation, there was some additional restoration required to the creek bank. So it kind of expanded on the project. So we're asking for additional $75,000 for this particular project. Okay. Next item is a new construction project that we bid. It's the Fenton Creek Pump Station Improvement Project. This action appropriates funds and authorizes staff to enter into a construction contract. The work to be done consists of construction of approximately 703 feet, 6-inch diameter force main, 839 feet of 8 to 12-inch diameter sanitary gravity sewer, and the replacement of a sanitary duplex pumping station and the equipment. The purpose of this project is to alleviate surcharging of the sanitary sewer and to replace the sanitary sewer pump station and force main, which have reached the end of their useful life. The district received 2 bids on this particular project. The low bid was from Kelp Contracting Incorporated. The bid was above our design estimate, and our appropriation of $1,575,000, which includes $75,000 for utility relocation and contingencies, is above the budget for the project. Our original budget was about $930,000. A couple things, we did have an increase in the size of the storage, sanitary storage, the 24-hour storage at the plant, which increased the cost. But what we have seen on some of our, particularly on pump station projects and small treatment plant projects, we are seeing an increase in our bids at where there's equipment involved, basically because of commodities and supply chain issues. But we are seeing an uptick. We're monitoring it. Of course, we had a treatment plant last month, came in around budget, so we're holding our own. But I would expect on projects similar to this, we will see some increases during this next fiscal year. Sewer projects have been maintaining pretty good so far. Any questions? Oh, I'm sorry. There was an MBE goal for this particular project. It's 17%, and Kelp Contracting is committed to 19.3% participation, which meets that 17%. All right. The next item is additional funds for an existing agreement we have with the Corps of Engineers on the Harlem-Baden Relief Phase 4 Goodfellow to Hamilton project. This ordinance authorized the district to appropriate additional funds. This is a project the Corps is building for us right now to administer and construct the project in the CRP. The project consists of construction approximately 7,200 feet of 12 to 40-inch diameter storm sewer and sanitary sewers and 3,000 feet of lining north of Kennerly and west of Goodfellow in the city of St. Louis. This project will reduce combined sewer overflows, taking separate flows to the Harlem-Baden, the separate storm flows to the Harlem-Baden detention basin. The Corps' construction estimate for this project was $7 million, and the construction began in 2021. This was a planned supplemental appropriation. With the Corps projects, the district pays 25% for the total cost of the project, and the rest comes from the federal government. And they get piecemeal money. In other words, they'll get a pot of money. They'll come back to us and say, here's the 25%. And then we budget that and appropriate that. So this is another piece of this project that will complete the project. Our appropriation is $1,279,000. Typically, our reimbursement is 25% of the project, but on projects, the district was responsible for utility relocation. So in this particular project, the district's total costs were $3,379,000, which is about a third of the project, a little over a third of the project versus 25%. Still a good deal for us. They managed the project through their bidding process. We did prepare the plans for the project, but they took it from there. So we continue to do that. The district has been working with the Corps probably for over 20 years, and we've gotten over $35 million in federal funding working with the Corps, and we're still authorized to go up to close to 70 million. So as they have money that they get for projects, we'll feed them the appropriate projects and continue to utilize those funds. And this is all separate of the new bipartisan infrastructure. So that's a totally different program. So we will potentially see some funds through the Corps with that program as well. Any questions?
Yeah. So this we're separating sanitary from storm in these 3 blocks, correct?
Yeah, actually, this is like an 8-phase project. What we did is in the Harlem Basin watershed, the district, the first project was a large stormwater detention basin. So what we're doing is going upstream where the combined sewer used to run down through the Harlem Basin watershed, and we're separating off like the street storm inlets and then taking that to the basin, and allows just the sanitary only flows then to go on. And what that does is prevent basement backups downstream of that basin location.
And then when the storm's done, you bleed that basin back through the sewer as long as you don't cause an overflow or flooding.
Okay. So my bigger question is how much of the separation have we accomplished?
We're
3 blocks. Is this?
Yeah, this is phase 4. There's a total of 8, so there's still several projects. So we're at, this size is a 48-inch, so it'll start getting smaller as we go up in the watershed. Our first separation was like a 72-inch storm pipe where we picked up the storm inlets. I can provide a map for you that kind of shows the phases going up if you'd like to see that.
That'd be interesting. I mean, but as a percentage of the system, though, I mean, of the system that, say, 10 years ago, before we signed the decree, how much of the system was separate, or no, how much of it was combined, and then what level are we at separation?
Keep in mind that we call this a soft separation. In other words, the homes are still, their downspouts are still connected. So it's still a combined sewer. What we've done is taking where you get your big source flow, the street inlets and things like that, and take it to the basin. Then it all combines. It still ends up combining and end up getting treated at the treatment plant. So really not reducing the overall combined sewer system.
Just slowing down the process of it getting into the system.
We're holding some of the storm water while the storm's going on.
Yeah.
And then let it slowly going back in.
Gotcha.
So
Okay.
Kind of the same concept as the green infrastructure.
Right.
We're putting the water into the ground. It may make its way back, and that's for the smaller storms, but on larger storms, it still gets into the combined system.
Cool. Thank you.
All right. Thank you. Good question. All right. Next item is a project called Fluorescent Done Sanitary Relief. We're requesting an ordinance to authorize staff to proceed with further condemnation efforts, including the filing of all necessary court pleadings and documents to the acquisition of permanent easements for this project. It's located, we're looking for potential condemnation on 3 parcels of ground located in the city of Florissant. Easements and temporary construction easements are needed for a project which consists of approximately 6,100 feet of 8 to 24-inch sanitary sewers. The purpose of the project is to alleviate building backups and surcharge sanitary sewers required by the, excuse me, required by the consent decree. There are 3 parcels that we've been unable to reach agreement. There were a total of 6 easements that are required for the project. So we're working with 3 property owners on this. In your documents, first parcel number 2, we actually are getting at least closer with this particular property owner. They have all the documents to be signed. We've made an offer and we're waiting for a counter offer, so it's potential that we could get this easement. Parcel number 3, this is located along Dunn Road. It's a pharmacy, so we really are just getting no response, and that's not uncommon with sometimes where they've sent it off to their main office and we don't necessarily hear back. So we have to, but in order to keep this project moving, keep it on schedule, we're requesting to go to condemnation on that one. And the final item, again, it's another pharmacy along this location. It's a very limited easement, but again, we're just having difficulty getting any response from the property owners. Then once we're authorized, a lot of times once they get this letter, they kind of then, it generally gets them acting. So it's hard to tell at this time whether we will go to condemnation on all 3, but a lot of times we're able to get these settled. These are not high cost easements. They're not high disruption. In other words, we don't have parking lots or anything like that. Any questions? Then the final item is a Gravois Creek OMCI stormwater. It's a design contract. It's a planned supplemental appropriation on this project. It appropriates additional funds and authorizes the district to amend a design contract with George Butler and Associates. This allows us to enter an agreement number 6 with George Butler, provide design services for a number of projects in the Gravois OMCI. This design supplemental will be used for post-design. In other words, we have a project that's getting ready to be constructed named Rico Avenue. It's in the city of Crestwood. So they'll review shop drawings and that from the contractors. We were just a little short on the design contract due to the number of contracts. We excuse me. We originally anticipated $30,000 in our budget. We're only going to need about $15,000, so that's the supplemental appropriation we're requesting today, again for George Butler. Are there any questions? That concludes the report. Trustee Nicholson.
Thank you, Rich. There is no other business. Next tentative meeting date, July 5th, 2022. Can I get a motion to adjourn?
So move.
Second.
Thank you.
Trustees will switch everything out.
Call order the 279th meeting of the Finance Committee. Get a roll call, please.
All right, we have noted all the trustees that are present.
Okay, can I get a motion to approve the committee meeting minutes of May 3rd, 2022?
So moved. Second.
I have no comments. On to the quarterly pension.
All right, thank you. On the phone, we have Peter Lemick and Mike Comstock from Ann, and they are going to review financial markets and the performance of the retirement plans.
Okay, good morning, everyone. This is Peter Lemick speaking. Hopefully everyone can hear me okay. We'll start on page 4 of our materials that hopefully everyone has in front of you. The title of the page says Major Capital Markets Performance Summary. And then the columns in gray, those numbers are going to be through the end of the first quarter of 2022. And then all the way to the right in blue, those are more updated numbers to give you a sense of how markets have moved so far here in April and for a majority of May as well. As I'm sure you all are well aware, it's been a much more different market environment here in 2022 so far than what we've experienced for, the previous 5-10 years before that, going through the end of 2021. The first column you can see, or the first row you can see there, global stocks in general down about 5.5% over the quarter. Still very strong numbers when you look at longer term performance figures. Look at the 3, 5, 10-year numbers. Those are all annualized figures. So even taking into account a poor environment in the first quarter of 2022, global stocks have returned 10% on an average annualized basis over a 10-year period. And that exposure within the pension plan has certainly been beneficial over the years, but in the short term, it's been much more challenging. Large cap stocks, you can see down about 5.1%. They have been outperforming their smaller cap counterparts so far here in the first quarter, but in particular, more value-oriented allocations have been outperforming their growth counterparts, and you'll see that when you look at the performance in the managers that are utilized within both the pension and the DC plans as well. And then towards the bottom, you can see U.S. investment grade bonds. These are your very high quality U.S. Treasury issuances, AAA corporate issuances that are held within the fixed income, about 25-30% of the fixed income allocation within the pension plan. Even they have faced very strong headwinds so far here in 2022, particularly with rising interest rates. Rates have increased pretty significantly so far here to start 2022. It seems to have moderated a little bit so far here in the month, with rates kind of bouncing around the 10-year U.S. Treasury yield, bouncing around from 2.8% to about 3.1%, kind of in that range over the past month or so. But certainly when those interest rates rise, the underlying holdings of your fixed income assets tend to depreciate. However, the good news there is where your fixed income assets really weren't garnering any yields for quite some time, their new investments going forward within the fixed income asset class are actually providing a bit of income within that portion of the overall plan. And then at the very bottom there, you can see core private real estate. You all have exposure here with the UBS Trumbull Property Fund. Real estate's actually held up quite well over the past year, returning that 1-year number, returning about 27%. And that's really a couple of things: rising income coming from rent from the underlying assets, and also the underlying appreciation of those assets. So a lot of properties were marked down kind of during the depths of the COVID economic lockdowns and mitigation measures. Since then, they've been repriced pretty rapidly, and that's been beneficial to the real estate portion of the pension. The following page 5, this is just a summary of really some of the three main factors that have been driving markets. Inflation, we're all feeling it. How high will it peak and how long will it continue? It's been very high over the past 12 months. Can we expect that on a go-forward basis? On the next page, you can see markets don't necessarily expect inflation to be as high as it has been over the short term going forward. The next item would be central bank tightening. How far will the Fed go in raising rates? And this is in an attempt to help quell inflation by rising interest rates. And it's still to be seen how far and how aggressively they will raise rates. But so far, they've been in line with what they've been communicating with several 6 or 7 rate increases over this calendar year. And then the Russia-Ukraine conflict, how long will it last and how long will the effects of it last? And how severe will they be, particularly on markets in Eastern Europe, African markets that are dependent on grain coming out of Ukraine and Russia, the natural gas supply, as I mentioned, to Eastern Europe, still to be determined on how long and how sustained the effects of this war will last. On the following page, page 6, just real quick here on the left, that inflation number, that 5-year break-even inflation, that is what the market is pricing in to be inflation on an average annualized basis over a 5-year period. You can see it's gone from back in May 2020, from essentially 0% inflation all the way up to so far here in 2022, 3.5% inflation. So the market is anticipating higher inflation on an average annualized basis over the next 5-year period, but not as strong as, say, the 6, 7, 8% numbers we've seen over the past 12-month period. You can see growth in the middle, the effect that rising oil prices have directly on expected GDP growth over calendar year 2022, and the tampering effect that can have on markets. And then the Fed rate hikes for 2022. These are the implied hikes, which we fully expect the Fed to be in line with how they have projected. And you can kind of see yield markets baking that into yields with the 10-year with the 10-year treasury rate hovering around that 2.83% range that I mentioned before. And then lastly, on page 7, this gives you a sense of the yield curve and how it's moved so far here in 2022. What we're looking at, the lighter line there, the lighter teal line, those are longer duration treasury yields. So for the most part, you all avoid exposure within the longer treasury yield range, just because you don't need to take on that amount of duration risk with the closed nature of your plan. That has moved up certainly so far here in calendar year 2022, and you all have avoided a lot of the effect, which has been a larger effect on the long end of the range. But then also on the short end, the darker blue line here, those are the 2-year treasury yields. You can see how much those have increased from essentially 0. The Fed had pinned those at 0 for several years, particularly in helping in trying to help stimulate the economy out of COVID. Now they are raising that in order to help stem inflation. So on the shorter end of the yield curve, we have seen rates increase pretty significantly. When we look at your DC plans, however, your participants have exposure to the short end via money market fund and stable value product, and this rising yield rate is actually beneficial to your participants over time because they're actually finally getting a little bit of yield out of their investments within that segment of the market. So let me pause and see if there's any questions before we get into the plans themselves.
No questions right now, Peter.
Okay, so maybe skipping ahead to page 11, this is a look at the total pension plan performance through the first quarter of 2022. As you might expect, with both equity markets and fixed income markets down, it's been a negative quarter on an asset basis. for your pension. I should mention that with those yields increasing, as I mentioned before, that's actually a benefit to your liabilities because they are discounted at interest rates, and then with those interest rates increasing, it tends to create lesser liabilities within the fixed income portion of your assets. The pension plan down about 5.1% over the quarter, trailing 1-year numbers up 2.5%, and 3-year, 5, 10-year average annualized numbers still strong above the now current 6.25% assumed rate of return from the pension. You can see beating that over the 3-5-year period and right in line with it over the 10-year period. Page 12 is a look at your total plan market value history. Despite the short-term markets and short-term decrease in assets on the pension for your pension assets, you can see over the long term growth has been very substantial, and particularly since the beginning of 2020 when assets were about $250 million, you're still right around $310 million in overall pension assets as of the end of April. Page 13, this is a look at your asset allocation versus policy targets as of the end of the first quarter 2022. All of your asset classes are in line with their allowable policy ranges. I would note the real estate column here, you see an underweight of about 3.5%. This is the UBS Trumbull Property Fund that is in the process of full liquidation. However, it's going to take a couple more years to fully liquidate out of that investment. While that investment is in the liquidation process, they still are delivering returns to the tune of about 7% over the past quarter. And we are working, with Tim and John and our real estate team on identifying appropriate investment managers to reallocate those assets as they come due. So you'll see more on the real estate side of the plan going forward. Pages 14, this is a look at the overall returns. As I mentioned, down about 5.1%, that top row there for the total pension plan. Within the various asset classes, domestic equity down about 6.5%. Your large cap passive allocation, that's 25% or so of overall plan assets, down 5.1% over the quarter. But looking out, as I mentioned before, how strong equity markets have been. For example, large cap U.S. equity exposure has still returned 16% or so over the 5-year period on an average annualized basis. So very strong generator for your assets over the long term coming from public equity exposure, particularly your U.S. large cap exposure. And then within the small cap equity portion, you utilize there's active management utilized within the plan, down about 9.7%. Over the quarter. However, 1-year returns much more favorable, down 0.5%, or essentially flat over a 12-month period versus a benchmark return of down about 6%. Within international equity, Morgan Stanley's active manager here down about 8.4% over the quarter, and over the trailing 1-year period down 6%. It's been a challenging environment so far here in non-U.S. exposures, in particular China, with continued slowdowns in their economic market for their zero COVID policy, shutting down large portions of their economy in their efforts to fight the spread of COVID in their country. And then also those markets that have exposure to Eastern Europe and are dependent on commodity supplies coming out of Russia and Ukraine have been negatively affected so far here in 2022 as well. Page 15, this is a look at the fixed income assets. As I mentioned, with the rising yield environment, it's been difficult for the underlying holdings of your fixed income assets over that time period. On a go-forward basis, we do expect it to be a more more optimistic environment in order to garner income for your fixed income holdings. But you can see income research down about 4.5% over the quarter. Prudential Core Plus Bond Fund down about 6.4% over the quarter. Longer term numbers for both of those managers still look positive, both on an absolute and relative basis. You can see the 5-year numbers for both income research and Prudential performing well versus their respective benchmarks. And then Brandywine, the same more, we would consider this more of a return-seeking type allocation within the fixed income portion of the plan, down about 2.5% over the quarter versus a benchmark return of down about 6.5%. And then finally, at the very bottom, April continued to be a tough month across capital markets with an estimated return down about 5.8% in the month, and through the end of May 24th, down an additional estimated 1.9%. However, that might be more towards flat or slightly positive, given how we finished the week last week in capital markets. So let me pause and see if there's any questions.
Peter, I don't see any questions right now.
Okay, flipping ahead or switching gears to the DC plans on page 16, the two pie charts that we're looking at the top of the page. On the top left, those are the combined assets as of the end of the calendar year 2021, and on the top right, those are the combined assets as of the end of the first quarter 2022. Overall, your assets have remained the makeup pretty similar over the quarter. Assets are down about $9 million due to capital markets so far over the first quarter. You can see the table on the bottom, a breakdown of the assets between the defined contribution plan, about $22 million in total, and much larger deferred compensation plan, which makes up about $100 million of total combined DC plan assets. And as a reminder to you all, those do have identical plan lineups between the two. Page 17, this is a breakdown of the underlying managers provided to your participants within the DC plans. Tier 1, these are your set it and forget it type target date funds. Those are for your participants that want to put their money in their retirement assets and not have to think about it again until their retirement years. As these numbers, or as these vintage years approach their targeted retirement date, they take risk essentially off the table by moving assets generally from return-seeking or public equity exposures into risk-reducing investment-grade fixed income exposure and some FIPS exposure and other diversifying income-generated exposures for your participants. And as you might imagine, additional equity exposure is going to result in larger or stronger returns over longer-term time periods for those participants. So at the bottom of the page, the 2065 fund, over a 3-year period, that's returned nearly 13% over that 3-year period, compared to, at the top of the page, the institutional target retirement income fund, those participants that are in their retirement years, returning about 6% over that time period. And that's really due to that more risk-off, more conservative positioning of those in retirement years. Page 18, Tier 2 assets. These are the passive offerings to your participants. We would expect these to return in line with their respective benchmarks, and they have. We don't have any major concerns with how the Tier 2 assets have provided. They are simply there to provide your participants the tools to gain very low-cost exposure to the broad capital markets. Tier 3, these are your active offerings to your participants. And in particular, you'll note that Vanguard U.S. Growth and Vanguard International Growth, they both have down quarters on both an absolute and a relative basis compared to their benchmarks. I would note, when you look at longer-term time periods, so 3, 5, 10-year time periods, those numbers in parentheses that you see there, Those are how those fund managers have performed relative to peers in the space. So other vendor offerings in, for example, a U.S. equity peer group or a non-U.S. equity peer group, and they've been very strong. So really what's been driving very strong returns over long time periods for both of these managers have been negative over the quarter. We continue to think their investment process and their investment teams are in place, are investing in line with their investment guidelines, but certainly been a bit of a reversal than what we've seen so far or over longer term time periods with both of those managers. And then, as I mentioned before, the Vanguard Cash Reserves Federal Money Market Fund and Vanguard Retirement Savings Trust 3. These are shorter duration capital preservation type vehicles offered to your participants with the rising interest rate environment lately, certainly much more appealing and getting a little bit of yield out of those allocations for your participants. And then the bullet point at the bottom is just a note that we have been going through what we call a fee benchmarking exercise with Vanguard to make sure that their record-keeping administrative fees that are being charged to your participants remain in line with competitive market pricing, and we've gone through the first round of that with Vanguard and a couple of additional vendors. They're essentially blind fee bids to make sure that what is being charged to you all is in line with market pricing. We've gone over those initial results with Tim and his team and are going back and forth with Vanguard now on further negotiation on your behalf and on your participants' behalf on those fees. Are there any questions?
No questions right now, Peter. Thanks.
Okay. The next two pages, pages 19 and 20, are just an update on the investment management fees for each of your investment managers in both the pension and for the DC plans. No major concerns here. We compare them to your universe peer medians, and overall, you all are garnering lower fees in general for your participants. One update I would like to just direct you to is within the appendix, we do have some peer comparison data on page 23. In particular, this is an update on how the MSD pension plan compares to other U.S. public pension investment return assumptions. As I noted, your return assumption has been lowered down to 6.25%. As of the end of fiscal year 2021. That is the comparison update here, and you can see the difference in the investment return assumption compared to other public peer plans, and that lower assumption is purposeful given the closed nature of your plan versus other public plans, which tend to be open and ongoing. On page 24, this is an update on the funded status of the plan, and you can see from the end of fiscal year 2020 to the end of fiscal year 2021, an increase in the funded ratio, which is currently at about right at about 87.5%, which is in the top 75th percentile relative to other public peers. So let me pause again and see if there's any last questions.
No questions, Peter.
Okay, that is all that we had for you today.
All right, Peter and Mike, thank you for your time. Trustees, I'll let you know we did just receive the actuaries' annual report, and so we'll have them in next month to review that. Peter and Mike, thanks for your time.
Thanks, Tim.
Thank you.
All right, we'll talk to you later.
All right, next item is the portfolio review.
All right, the portfolio review. This is the report, one page we look at every month just to give you an idea of how much money we have and how it's invested. So our overall portfolio is down about $50 million from last year, and that's because we had large debt service payments in May. Our senior debt, principal and interest payments are due in May and November, so we made that payment. Overall yield to maturity for our portfolio, I'm in the upper left-hand square right now, is up about 14 basis points to almost 90 basis points total. Still short of a full 1%, but gaining as rates go up and our new investments. Remember, we only turn over a little bit of our portfolio every month. As our new investments are invested at higher rates, our portfolio is going up. We cannot go up as fast as the treasury market, which is the entire benchmark turns over every month. But actually, because we saw some rate relief a little bit at the end of May, that benchmark actually fell slightly. So it's a little bit lower than where it was last month. Our weighted average maturity, which is the WAM, is up for our portfolio just slightly to about 1.5 years. So our average investment goes out about 1.5 years. Looking at the sector allocation in the upper right, we are within our policy limit, so that's what we look at. Commercial paper, which had been higher, because that is where when rates were really low, where we could get a little bit more yield, is lower because now we're getting some better rates on some longer-term investments, and so that's why we've gone on a little bit longer. Fund summary in the bottom left. The only thing I really want to point out there is you can see the debt project fund, only about $4.3 million in the portfolio. That'll go up next month because we just borrowed $100 million, which I'll talk about in just a minute. Everything else there looks pretty similar to where it has been. And then the maturity distribution in the bottom right doesn't look that much different than it has. Look, we've got a little bit under half of our money coming due in the next 1 year, and that's typical. We use that as well as incoming cash to fund operations and projects and that sort of thing. All right, so I've got one more item to talk about, and this is just going to be a brief update on the bonds that we just issued. So if we can come up to the next presentation on that summary results page. So we went out for $100 million of par. Bonds are how still the primary way that we fund our capital program. Just you can see, as I just talked about, we only had about $4 million left in our project fund. So it was time to go out for some new money. Went out for $100 million. We got about $13 million in premium. That's a little bit higher than where we expected to be last month when I gave you an update. The all-in true interest cost of the bonds is just over 4%, roughly where we thought it would be last year. Weighted average maturity of these bonds are 19 years. So we usually structure these kind of bonds kind of like a mortgage where you've got roughly the same principal and interest costs each year. We don't pay monthly, but we pay semi-annually. So the average weighted maturity of our bonds is about 19 years. We were able to get a little bit of a refunding. That was in question as rates had gone up, where the amount of refunding savings had dropped and actually endangered having any savings at all. So we were able to issue about $9 million of refunding debt. Not a huge savings, only a few $100,000 over the next 2 years. So we were able to basically refund a maturity that was going to be due in 23 and 24 to save a little bit of interest expense, much lower rate of savings than what we've had in previous refunding transactions, and that's just because rates have gone up so much. Still, on an NPV basis, the savings was about 3%. That's probably lower than what we would accept if we were going to do an advanced refunding, but this is considered a current refunding because those bonds that we refunded are actually callable already. The all-in true interest cost on those bonds, about 2.5%, weighted average maturity of just under 1.5 years. So the next page, this is really what I wanted to show you. When you approve the bond ordinance, we ask you to approve parameters. That saves us from having to come back with a special meeting on the day of the pricing and have you have a special board meeting where we have to make sure everybody's available all at the right time to approve specific the actual bond statistics that we were able to get in the market. So we build parameters. They're usually pretty loose and broad because we don't know how the market's going to move. And at the time we set the parameters, we're still negotiating some of the pricing pieces. But principal amount, we knew we were going to have less than, actually that's the total amount that we received, less than 100. No, I'm sorry, that is the principal amount, $115 million. Our total bond principal amount was 109. That's the new money and the refunding. Purchase price, we were still expecting premium, but the parameter was that we may have to go a little bit of a discount. But overall, we received a little over 12% premium on these bonds, meaning we borrowed. If we borrowed $100 million, we received $102. In this case, we borrowed $109 million, received a little bit over $120. million of total proceeds. True interest cost parameter there was pretty wide. We wanted it to be, or it couldn't be greater than 5.5%. Our true interest cost was just over 4%. Issuance costs, not counting the underwriter's discount, less than 1%. We were actually less than 0.5%. Final maturity was right what we expected. These are the final maturity is 30-year bonds, so May 1st, 2052. We do have a 10-year par call, which is what we expected. We would have been open to a shorter call if it was available, but we ended up with 10-year par call, which is pretty standard. And the net present value of savings, since it was a current refunding, we are willing to accept lower savings than we typically do, but we still were over the minimum that we would have accepted, 3%. So the final, there will be a certificate in the final transcript of the bonds that show all of these results, while the original bond ordinance has the parameters in it. So, and then what we'll do is we'll have PFM and IPA, who are our municipal advisors, we'll have them in hopefully next month, and they'll go through in a little bit more detail, just kind of some of the market conditions, some of the things that we experienced. They'll do some comparisons to other issues around the same time. They'll give you a fairness opinion on the pricing of the bonds. So they will provide what's called a financial advisor's memorandum that gives you a little bit more information. It was, on the last page here, I just wanted to show you a little bit. This is the last pricing update on municipal bonds I'll give you for a while. We had looked in the last couple of months about how, even though rates from a historical standpoint were still relatively low, over the last 6 months, they'd gotten as high as they've been almost in the last 5 years. They were high from that standpoint. So this is just since the last update, kind of what bonds have done. So that black line at the bottom is where rates, municipal rates across the curve. So these are different years to maturity levels where yields were, that black line at the bottom. So you can see that during the last month, rates rose as high as the top of that gray kind of cloud. So rates continued to rise throughout the month, but actually when we went to market, we had a couple days where rates had softened a little bit. So the day before we priced, rates were down at the red dotted line. And the actual day we priced, they were at that blue line. So we were starting to see some decent drops, 10 basis points a day during that time. So we didn't hit it at the worst time of the month. So that was helpful. Rates did continue to improve a little bit throughout the week. So we'll see what they do. But I think overall, we're happy with where we priced. We were fortunate in that there were not a lot of other transactions in the market. So we weren't competing with a lot of other transactions for money. We ended up actually being 11 times oversubscribed, which is not what we expected and not what we were told to expect. So that means that while we went out for $100 million, we basically received an order book of over $1 billion of orders.
Who's the underwriter?
Bank of America was the lead underwriter, and then we had a few other banks that were kind of co-underwriters, but it was led by Bank of America.
And was there a retail piece?
We got about 4% in retail. So we give priority orders to retail. With the increase in rates there, what we were told is there just hasn't been as much retail order as typical. But we got about 4 million in retail orders. And those were priority orders. So all the retail orders were filled before any institutional. I think we had over 50 institutions come in, so that's good. That gave us a little bit of pricing leverage. So what happens is we usually, night before, since rates had gone down a little bit, we lowered our initial indications. When we went out to the market, we said, okay, this is about the rates we expect. We lowered that expectation. Then because rates softened again and we were getting so many orders, we were able to go back and negotiate, again, some lower pricing. Sometimes what happens is you lose some of the investors, but as long as you overall can get the money that you want to get, that works out. So from that standpoint, everything was successful. We're glad to say we received the $100 million that we needed to fund the capital plan going forward. And then the next few bond issuances we expect are going to be more from state revolving fund and possibly the WIFIA program, as we talked about before. So it'll be a while, I think, before we're in the capital markets again, unless there's a refunding opportunity. But rates would have to fall for that to happen. Any questions? All right, that's all I have for today. Thank you.
All right, next tentative meeting date is July 5, 2022. Do I have a motion to adjourn?
I'll move.
Thank you.
We will get prepared for As soon as Trustee Wabi gets back, we're ready to go.
Okay.
Yeah, I think everyone's back. I'd like to welcome everyone to the Stakeholder Relations Committee meeting of the May meeting. Can I get a roll call, please?
Yep, we'll note that all trustees, we'll note all of the trustees that are present.
Okay, thank you. I have no comments. Get a motion for approval of the May 3rd committee meeting.
So moved.
Okay, with no objection, minutes are approved. Item 4, Ms. Meyer, would you like to take the next couple of items?
I would, thank you. Good morning. The first item is proposed resolution number 3757, and that resolution will authorize the renewal of the contract with Cardinal Point Partners, LLC, for federal legislative services. This would be authorizing the third of 4 option years. This contract was a 1-year contract with 4 one-year options. So we would be in actually the 4th year of the contract, but it's the 3rd option year. So that contract will expire in June of 2024, which means that we would go out with a new RFP for these services earlier, like springtime of 2024. Brent Franzel is our federal lobbyist. He's been our federal lobbyist since about 2009. He's done a very good job for us. Pre-COVID, Brian and I would go to DC on an annual basis, and Brian, Brent, and I would go around and meet with the congressional delegation. We have not done that since 2019. So Brent has kind of carried that pail for us in person in DC as much as he can. Typically, we coordinate with him to deliver packets to the different congressional delegations that show a project map of projects going on in each of their areas, and then any information, that's been going on, such as last year. We gave them an update of the 2021 Prop Y authorization, and then also the charter amendments that we had taken, to the vote of the people. So what this proposed resolution will do is authorize an additional option year. Any questions? Okay, hearing none, I'll move on to item number 5, which is actually, I'll be talking about 4 proposed resolutions. The my office uses we use outside counsel for certain situations. So we have a suite of 4 different law firms that I have the option of using depending on what kind of matter comes up. Again, these were 1-year contracts with 4 1-year options. We went into the initial contracts in 2019 with 4 firms: Armstrong, Teasdale, Thompson, Coburn, Reinierson, Sue, Schnurbush, and Champion. And at that time, it was the Hale law firm. Larry Hale, who was the principal of that firm, passed away in January of 2020. So in January of 2021, I added the White, Coleman, and Associates, a law firm. So the 4 law firms I'll be talking about today are Armstrong, Teasdale, Thompson, Coburn, Reinierson, and White, Coleman. Again, like I said, all 4 of these contracts, they will expire in 2024. So again, we'll be going out with a new RFP in the spring of 2024 for outside counsel services. So now I'll go through each of the resolutions specifically or individually. So just stop me if you have any questions on anyone. So the first is proposed resolution 3753, and it'll authorize the renewal of the contract with Armstrong Teasdale for, again, the 3rd of 4 option years. Armstrong Teasdale is a full-service firm. We have primarily used them over the last year or so for human resource matters. They've helped us extensively through the COVID guidance. They also provide services for our pension plan. Again, they can provide a full suite of services, but that's primarily what we've used them for over the last year. We've had a contract with Armstrong Teasdale since 2005. And for this particular, our last fiscal year since July of 2021, about 8% of my total spend has been with Armstrong Teasdale. Any questions about Armstrong? Okay. The next proposed resolution is 3754, and this would authorize the renewal of a contract with Reinierson, Seuss, Schnurbush, and Champion. Again, it's for the 3rd out of 4 option years. We've used, I'm just going to refer to them as Reinierson, so I don't have to go through all the names. But over the last year, we've primarily used Reinierson for, we've done some negotiating with FEMA for flood reimbursement. They've helped us with contract protests. They've helped us with a number of inverse condemnations. Those are property damage cases, and also some personal injury. We have been under contract with Reinierson. We've had them available to us since 2012. And for the total spend from last July, they are about 14% of our total spend. Okay, the next proposed resolution is 3755, and it will authorize the renewal of a contract with Thompson Coburn, again for the 3rd of 4 option years. Thompson Coburn, over the last year, we have primarily used them for environmental services. We've had some air permits for our incinerators at Bissell Treatment Plant and Lee May Treatment Plant. They've helped us with that process. They've helped us with some property condemnations, also some inverse condemnations, and then they helped us with the Howard Bend Levy District assessment protest that I'm sure you all remember that we went through. We have had a contract with Thompson Coburn since 2005. And for this year, they've been about 62% of our total spend. Any questions? Okay, the next proposed resolution is 3756, and it will authorize the renewal of a contract with White Coleman and Associates. If you remember, as I said in my opening, we brought White Coleman in later than we did the other three due to Larry Hale's passing. So this resolution will authorize the second of 3-year options. We began our contract with White Coleman in January of 2021. And this past year, she has provided services to us primarily in the area of inverse condemnations. Again, that's typically property damage from either flooding, stormwater, sewer backups, that sort of damage. And this year, she has been about 16% of our total spend. White Coleman and Associates is 100% MWBE. So, any questions on White Coleman? Okay. Is there any questions on any of them that I covered? Otherwise, that concludes my resolutions.
Okay, thank you, Ms. Martin.
Okay, thank you.
Mr. Holscher.
Yes, sir. I wanted to give just an update on the rate commission selection process. I got it at the end, but I'll let you know nothing's required of the board at this time. But I just want to make you aware of what's going to be coming up in the future. This is something that gets done every 4 years, so it's not something you see every year. Usually every 4 years, MSD staff develops a rate proposal for review by the rate commission before consideration by the MSD Board of Trustees. A rate proposal always includes a component to address the needs of our wastewater system, especially the rates and any additional bonding authority needed to primarily address our consent decree requirements. There's also an opportunity to propose new services. In this case, MSD will also be submitting a rate proposal to address stormwater issues such as flooding and creek erosion throughout the district, for which there is currently no district-wide revenue source. The next rate proposal is scheduled to be submitted to the Rate Commission by staff around February 2023. The selection of the 15-member rate commission is the responsibility of the Board of Trustees. Each member organization is selected for a 6-year term. Thus, 10 of those 15 organizations' terms will have expired before the next rate proposal is considered. MSD staff is currently checking on the status of the 5-member organizations whose terms have not expired. Those include the St. Louis Council of Construction Consumers, Missouri Botanical Garden, League of Women Voters, Lutheran Senior Services, and Education Plus. Once that's completed, staff will advertise for the remaining positions sometime in June. The process will consist of staff advertising, then receiving letters of interest, and finally scheduling a time for the interested parties to make a 3-minute presentation to the Board of Trustees. This should occur either in July or August. The trustees will be required to select organizations to fill the vacant spots on the rate commission. Section 7.320 of the charter provides guidelines for the Board of Trustees to ensure that the organizations shall be selected by the board so as to ensure a fair representation of all users of the district services. Staff will make sure this information, along with any additional information such as past participation of organizations, are made available to the Board of Trustees as part of the process. The schedule is to have the new rate commission selected by the Board of Trustees by October, so that the new rate commission has a couple of months to schedule business meetings prior to staff submittal of the next rate proposal in February 2023. Again, there's no actions required by the Board of Trustees, but if you'd like, if you've got any questions about what I just presented, I can answer them at this time. The process will be very slow and deliberate. You will not get overrun. We'll make sure you have plenty of information. If there's no questions there, Chairman, one other item. As you know, we recently switched over my executive assistant, and for reasons I can't completely understand, we will need to reschedule all your calendar bookings for the committee and board meetings. So you will see cancellations and rescheduling going on so we can transfer everything over to Wendy. Wendy's going to send you an email sometime this week explaining what to expect as we go through that process. As things get canceled, as new things get scheduled. So once she sends it out and the process starts, if you have any questions, feel free. I would recommend to call her instead of me. to get an answer as to what's really going on. So she'll be sending that out sometime this week. Mr. Chairman, if there's no questions, that's the end of my report.
Thank you. Anyone have anything for the good of the body? If not, I'll entertain a motion for adjournment.
So moved.
Second.
Thank you. It's been a pleasure in my life again. The meeting is adjourned.
Thank you.